2 a.m. alert, and the COMEX data that just updated is telling a story the paper price on your screen is not. Registered silver is down 22.1% in the last 30 days, 22.4 million ounces withdrawn. Coverage ratio now sits at 13.7%. That is stress territory. At the current pace, inventory depletion is roughly 74 trading days out, 13.7%. That number, live right now, is not just another metric. It is the metric that answers the only question that matters. Has the silver squeeze already started? Not could it start? Not what if it starts? Has it already begun? And when you align the coverage ratio, the backward rolling pattern, the SLV vault withdrawals, and the 1.3 billion ounce cumulative deficit, the data gives a single answer. Yes, but not where most people are looking, not in the paper price, in the physical market, and where the real metal actually exists. Before we go any further, if you're new here, subscribe now. Turn on notifications. This channel runs on primary data only. No summaries, no opinions disguised as facts, just raw source material. And drop your answer below. One word. Has the squeeze already started? Yes or no? Let's go. Now let me show you the exact COMEX data flip that defines what already started actually means. Go back to early January. Open interest in the January 2026 contract increased by 1,131 contracts, while deliveries were happening. Think about that. In a normal market, traders roll forward. March to May, May to July. They avoid delivery. That is the fingerprint of a functioning paper market. But what happened here? They rolled backward. From future months into earlier months, January, February, demanding immediate delivery. That is not normal behavior. That is urgency. That is a signal that participants no longer trust future availability of physical metal. It means waiting is riskier than acting now. It means they are front-running a potential shortage. And when that behavior appears, it tells you the physical market is tightening. Now layer in the scale. In just 7 days, COMEX warehouses saw 33.45 million ounces withdrawn. 26% of registered inventory gone in 1 week. At the same time, new buyers entered the market demanding delivery. So you had metal leaving and new demand rising simultaneously. That combination accelerates depletion faster than any normal cycle. Now the 3 signals that confirm the flip. Signal 1, SLV vault withdrawal. For the first time in years, metal is leaving the custodial vault tied to the largest silver ETF. That matters because SLV is not supposed to be a source of supply under stress. It is supposed to be storage. When metal starts leaving there, it means demand is reaching into the deepest, most liquid pools available. That is escalation. Signal 2, the 1.3 billion ounce cumulative deficit. Since 2019, the silver market has been running a structural shortage year after year. This is not a one-time imbalance. This is a multi-year deficit that now exceeds an entire year of global mine production. That means the system has been absorbing more silver than it produces, continuously. The paper price does not reflect that reality, but the physical market does. Signal 3, institutional acknowledgement of squeeze risk. Major financial institutions are now openly stating that silver is increasingly vulnerable to liquidity squeezes, not hypothetical, increasingly vulnerable. That aligns perfectly with what the data is already showing. Now understand the mechanism. When enough contract holders demand physical delivery, the exchange has only 2 options: deliver metal or settle in cash. And every time cash replaces metal, the system loses credibility as a true price discovery mechanism, because the price is no longer tied to physical availability. It becomes financial, not physical. Now look at the leverage. Hundreds of millions of ounces in open interest, backed by a fraction of that in registered inventory. Multiple paper claims per ounce of actual metal. That structure works until too many participants demand delivery at once. And that is exactly what the backward rolling behavior is signaling. The January price drop cleared speculative leverage, but it did not fix the physical imbalance. The metal is still committed, still spoken for, still constrained. Now the counterargument. Banks project an average silver price range for 2026 between $55 and $70, but current prices are already above that range. So either the squeeze is already pushing prices beyond expectations, or those projections underestimated structural demand, or current pricing includes temporary geopolitical premiums. All 3 can be true at the same time. Now the timeline. At the current withdrawal rate, 74 trading days. That places potential exhaustion mid-2026. But the timeline depends on one critical variable: eligible to registered conversion. There is additional silver in vaults, but not all of it is available for delivery. If that metal converts, it can slow the drain. If it doesn't, the squeeze accelerates. So watch the signals, Watch the coverage ratio, watch warehouse reports, watch whether contracts continue rolling backward. Watch lease rates, because when lending tightens, stress becomes visible fast. Because silver is no longer just an industrial metal. It is now three things at once: industrial, monetary, strategic. And when those three demand streams converge on a constrained supply, the system doesn't adjust smoothly. It snaps. The data at 2 a.m. just confirms something critical. 13.7% coverage,